Benjamin Graham, think of him as the grandfather of value investing. He laid the foundation for what we now consider the bedrock principles of smart investing. Published back in 1946, his book, The Intelligent Investor, is like the Bible for anyone who wants to grow their money safely over time. It's not just a book, it's a comprehensive guide that has stood the test of time, offering wisdom that is as relevant today as it was over 70 years ago. Graham wasn't about getting rich quick. He was all about avoiding big losses and letting your money steadily compound. His philosophy was centered on the idea of long-term growth and stability, rather than short-term gains that could easily evaporate. What's amazing is that even though the investing world has changed a lot since then, Graham's core ideas are still rock solid. The principles he laid out are timeless, providing a sturdy framework for investors to navigate the ever-evolving financial landscape. Think of it like this. Fashion comes and goes, but the basic principles of good design never go out of style. That's Graham's wisdom. Just as a well-tailored suit remains a staple in any wardrobe, Graham's investment principles remain essential in any financial strategy. Now, Graham wasn't some ivory tower intellectual. He was a practical man who understood the real-world implications of his theories. He was a Wall Street guy who had lived through the ups and downs of the market, including the crash of 1929. This experience gave him a unique perspective on the volatility and unpredictability of the market. He knew firsthand how emotions could wreck even the smartest people's finances. The fear and greed that drive market cycles were not just theoretical concepts to him. They were real forces he had witnessed and experienced. So, his book is packed with practical advice on how to think clearly and rationally about investing, no matter what the market is doing. It's a treasure trove of strategies designed to help investors stay grounded and make informed decisions. It's like having a wise mentor guiding you, helping you avoid the pitfalls that trip up so many others. Graham's teachings are like a beacon of light, illuminating the path to financial wisdom and stability, ensuring that you can navigate the complexities of investing with confidence and clarity. Imagine you're at a flea market, surrounded by all sorts of stuff. The air is filled with the hum of chatter, the scent of street food, and the sight of countless items waiting to be discovered. Most people are drawn to the shiny objects, the ones that catch the light and seem to promise instant gratification. But you're different. You're a value investor. You're looking for that hidden gem, the antique clock worth a fortune, being sold for pennies on the dollar. You know that true value often lies beneath the surface, hidden from the untrained eye. That's what value investing is all about. It's about digging deeper, beyond the superficial allure, to uncover the real worth of an asset. It's about finding great companies that are undervalued by the market. These companies might not be the talk of the town, but they have solid fundamentals and a promising future. They're like diamonds in the rough, overlooked by others who are blinded by short-term noise. While others chase after the latest trends, you focus on the intrinsic value. Graham teaches us to analyze companies based on their fundamentals, their earnings, assets, and dividends. It's a meticulous process, but it's worth it. He wants you to understand what a business is truly worth, not just what the market says it's worth today. This means looking at the bigger picture and considering the long-term potential. Think of it like buying a house. You wouldn't just look at the asking price, would you? You'd consider various factors to determine its true value. You wouldn't just look at the asking price, would you? You'd look at the location, the size, the condition, and compare it to similar houses in the area. You'd want to know if it's a good deal. You'd look at the location, the size, the condition, and compare it to similar houses in the area. You'd want to know if it's a good deal. The same principles apply to value investing. Value investing is the same, but instead of houses, we're looking at companies. We analyze their financial health, their market position, and their growth potential. The goal is to buy these undervalued companies and hold them patiently. Patience is key, because it might take time for the market to recognize their true worth. As the market eventually recognizes their true worth, your investment grows, often significantly. It's a rewarding process, both financially and intellectually. It's about being a smart shopper, finding bargains, and letting time work its magic. Just like in a flea market, the thrill lies in discovering something valuable that others have overlooked. By following the principles of value investing, as taught by legends like Benjamin Graham, you can build a portfolio that stands the test of time. It's not about getting rich quick, but about making informed decisions that lead to sustainable wealth. It's a journey of continuous learning and disciplined investing. So next time you're at a flea market or evaluating stocks, remember to look beyond the surface. The real treasures are often hidden, waiting for someone with the insight and patience to find them. Unearthing hidden treasures is not just a skill, it's an art. And with practice, you too can master it. Imagine you're building a bridge. You wouldn't just build it to hold the expected weight, right? You'd build it stronger, just in case. That extra strength, that's your margin of safety. In investing, the margin of safety is the difference between a company's price and its intrinsic value. It's like having a buffer, protecting you from losses if things don't go as planned. Graham was a big believer in buying stocks with a large margin of safety. He knew that even the best investors make mistakes, and sometimes unexpected things happen. Think of it like this. You buy a shirt on sale for $10, even though you know it's worth $20. You've got a 50% margin of safety. Even if the store messed up and it was supposed to be 15, you're still getting a good deal. The larger your margin of safety, the less you stand to lose if your analysis is wrong. It's like having a safety net, allowing you to sleep soundly at night, knowing your investments are well protected. Section 4. Mr. Market and You. Don't be a puppet. Let's meet Mr. Market, an imaginary character Graham created to represent the stock market. Imagine Mr. Market as an unpredictable fellow who shows up at your door every day, offering to buy or sell stocks at various prices. Some days he's euphoric, offering ridiculously high prices. Other days he's depressed, practically begging you to sell at rock-bottom prices. The thing is, Mr. Market is driven by emotions, not logic. Graham's point is that you shouldn't let Mr. Market dictate your investment decisions. You shouldn't get caught up in his mood swings. Instead, you should use his irrationality to your advantage. When Mr. Market is fearful, be greedy. Look for those bargains, those hidden gems that he's overlooked. And when he's greedy, be fearful. Don't overpay for something just because everyone else is excited. Remember, you're in control. You decide when to buy and sell, based on your own analysis and your own timeline. Don't let Mr. Market turn you into a puppet dancing to his tune. Section 5. Defensive versus enterprising. Which investor are you? This is a crucial question every investor should ask themselves before diving into the world of investments. Benjamin Graham, often referred to as the father of value investing, understood that not all investors are created equal. His insights have shaped the way we think about investing today. Some investors prefer a hands-off approach, enjoying the peace of mind that comes with minimal involvement. They might be found relaxing on a beach, occasionally checking their investments on their phone. To address these different preferences, Graham categorized investors into two distinct types: defensive and enterprising. This classification helps investors understand their own tendencies and make better financial decisions. The defensive investor prioritizes safety and stability above all else. They are more concerned with preserving their capital than achieving high returns. Often, defensive investors are busy professionals who don't have the time or desire to actively manage their investments. They prefer to set it and forget it, relying on automated investment apps and financial advisors. They're content with a simple, diversified portfolio that generates steady returns over the long term. This approach minimizes risk and provides a sense of security. The enterprising investor, on the other hand, is willing to put in the time and effort to research individual stocks. They enjoy the challenge of finding those hidden gems that others might overlook. Enterprising investors are more active in their approach, constantly seeking to outperform the market. They thrive on the excitement of trading and the potential for higher returns. So, which one are you? There's no right or wrong answer. Both approaches have their merits and can be successful if executed properly. It all depends on your personality, your risk tolerance, and how much time you're willing to dedicate to managing your investments. Understanding these factors is key to choosing the right investment strategy. Graham provides specific strategies for both types of investors, helping them achieve their financial goals. Whether you prefer a conservative or aggressive approach, there's a strategy that can work for you. The key is to know yourself and invest accordingly. Self-awareness is crucial in making informed investment decisions that align with your goals and comfort level. Don't try to be someone you're not. Embrace your natural tendencies and choose an investment strategy that feels right for you. Once you've chosen your approach, stick to it. Consistency is vital in the world of investing. By staying true to your strategy, you increase your chances of achieving your long-term financial goals.